in Nigeria. Just like every other country, what we realized in Nigeria was that there was a structural gap, and the Nigerian domestic financial system was not exactly participating in the carbon market. And when we are talking about the carbon market here, we are not even specifically talking about the clean cooking segment alone. We are basically talking about all the segments within the market, the DREs, even the nature-based programs. Our financial institutions were not getting involved. We realized that carbon credits were absent from Nigeria's green taxonomies. We realized that banks and insurance companies were not exactly comfortable insuring within the carbon value chain, because for a lot of them, they didn't even understand it, and they were not sure about the risk they were getting into. We also realized that Nigerian credits were mostly financed by foreign organizations and foreign financial institutions. Because there was no insurance for the entire value chain, developers carried a lot of risk, and even at some point, especially within the voluntary carbon market, some of those carbon credits were basically cancelled. We also realized that a lot of the value of these assets then do not exactly accrue to local institutions. They basically accrue to foreign institutions because they basically take the risk and finance a lot of this. Rajiv already took us through this process. This was the same process that was done in Kenya, and it was from this that we borrowed from. And based on this process that Rajiv already explained, we came up with about 15 interventions. And those 15 interventions were categorized into 3 buckets. The first bucket talked about establishing a stable carbon market infrastructure, and I wouldn't have enough time to explain it one by one. I'll just list the intervention. The first intervention talks about the prevention guidance on carbon credit asset treatment. Basically, can we get the regulators to release a prudential guideline on how carbon credits will be treated if financial institutions actually invest in it? Second one talks about carbon credits as mitigators in banks' climate risk. We all know that financial institutions face this different type of risk. Is there a way they can use carbon credit as mitigators to some of the climate risks that they face? The third one talks about covering carbon credits in ESG climate disclosure. The fourth one talks about integrating carbon credit data into climate risk databases. The fifth one talks about incorporating carbon credit in stress testing framework. Basically, the first 5 talks about establishing a stable carbon market infrastructure. They are fundamental. We think these interventions are fundamental. The second bucket looks at interventions that can exactly expand the market and increase participation of financial institutions. And we looked at around interventions around supporting insurability for the carbon credit value chain, basically from end to end. How do we ensure that people that are, so for example, if I've invested in the value chain as an aggregator, if a project fails as a result of factors beyond my control, do we have insurance within the country that could mitigate the risk? Can we ensure that we classify clean cooking and clean energy projects within the green taxonomies within the country? That's the 7th intervention. The 8th intervention then talks about incorporating clean cooking in green bond frameworks. So, for example, if you look at the green bond framework of the Securities and Exchange Commission at the moment, it does not incorporate clean cooking. We thought that could be a quick win, and if it's integrated in the green bond framework, we have the opinion that it could help raise funding, local funding for some of the projects within this segment. We also thought about incentivizing loans for carbon credit related projects. What sort of incentives can we give financial institutions to ensure that they are able to fund carbon credit related projects? And when we talk about incentives, a lot of the time we think about tax break. It's not just tax break. We were discussing with an institution, and they spoke about the adverse capital requirements, capital provisioning requirements they need to make if they fund corporate corporate projects like this, they thought about it that if the regulator could reduce that for carbon-related projects, it could be an incentive for them to start lending. We also spoke about standardizing listing on the floor of the exchanges in Nigeria. For example, in Nigeria, we are talking about having a derivative exchange. How do we basically treat this and ensure that carbon credits, carbon-related instruments can be listed on such a platform? The 11th one talks about clarifying carbon credits in ESG mutual funds portfolio. What we realized in discussing this is that we really do not have ESG portfolios yet in Nigeria, but it's something we could start paying attention to. The 12th one talks about incubating carbon credit linked bond instruments, incubating securitized carbon transaction, and also a backstop guarantees for minimum price support to ensure that when developers invest in these things, they have some guarantee that no matter what, they would get some minimum pricing. Also, local insurers that are getting exposure and trying to mitigate the risk, they are looking at what sort of backstop guarantees, maybe in form of reinsurance or in form of co-insurance, can we exactly put in place to ensure that they are not unduly exposed to this risk. So basically, and in Nigeria, we had one-on-one engagements like they had in Kenya. We have stakeholder intervention just to validate some of these interventions and to see which ones we would prioritize from a regulatory perspective. And my slide here shows what was basically prioritized. And I would just list the top four. It was to incentivize loans for carbon credit related projects. It was to cover carbon credits in ESG and climate disclosure. A lot of the people we spoke to thought this was a quick win because Nigeria is already a signatory to the IFRS. I think IFRS S1 and S2 that basically talks about ESG disclosure. And we're already at the point where organizations are supposed to be disclosing voluntarily before we get to a phase where it's compulsory. So we thought that was a quick win. Integrating carbon credit data into climate risk database without a clear view of what is happening within the market. Financial institutions might not exactly be very comfortable. So basically, we need to start thinking about how to integrate this. The fourth one talks about incubating carbon credit linked bond instruments. A lot of the people we spoke to actually thought that if we could demonstrate this through a pilot project, that it would be easier to convince financial institutions and even maybe regulators, because financial institutions would basically follow the money. The fifth one talks about carbon credit as mitigant in banks' climate risk. Banks already do climate ESG disclosures and the likes. We need to start encouraging them to include carbon credit as one of the mitigants for the risks that they face, or for the risks some of the projects that they finance face. Classifying clean cooking in the national green taxonomies, we understand that the Federal Ministry of Finance, in collaboration with the Federal Ministry of Environment, is revising Nigeria's green taxonomy. Is there a way we can get involved with them and also ensure that some of these things are included in the green taxonomy? The seventh talks about supporting insurability for carbon credit value chain. Basically, how do we ensure that developers, project sponsors are not unduly exposed, that we have local financial institutions, local insurers that can backstop some of these projects in form of insurance. The last but not the least, which came up as one of the most important in all our one-on-one engagements, was the prudential guideline, because banks typically, or financial institutions, don't like to go to the market blind. They don't want to invest in something that would then be punitive.
Sorry, I was trying to. So what I'm trying to say is that, ouch.
So they don't want to go, they don't want to fund things that could be punitive, where the central bank would then say, you would have to make this extent of provision. They want to understand the regulatory perspective to funding some of these projects. They want to understand how it will be treated within their capital stack. Yeah, so those are like the 8 top interventions that came up with during the bilateral conversation and the stakeholder engagement we held in Abuja sometime last month. Basically, when we move away from this intervention, we'll be moving to a phase 2, and this is already happening in Kenya, where we are already trying to work on a sandbox, and we'll be sandboxing some of the interventions. We'll be basically in Kenya at the moment, they are issuing guidance on carbon credit asset prudential treatment. Clean Cooking Alliance and the VCMI are working with the Central Bank of Kenya to issue this guidance. They are also working on another top intervention by looking at ways of standardizing and listing, trading, and clearing carbon credits and linked products in Kenya within the Kenyan broader financial market. So right now, the second phase includes a broader stakeholder engagement for activities selection, and basically we'll be going into a pilot phase to test some of these interventions, which are very similar. The interventions in Kenya that were shortlisted in Kenya and the interventions shortlisted in Nigeria are very, very similar. I'll hand over to Catherine now. Thank you so much for listening.
Great, thanks so much, Akin. Let's move on to Benson and the panel.
Great, thank you so much, Catherine. Thanks a lot, Rajiv and Akin, for a terrific job in terms of setting the context and explaining where we are coming from and the priorities from the two countries, i.e. Kenya and Nigeria. I think the context is very clear. And so I think we would want now to shift gears a bit and get into a panel conversation to help us unpack this a bit more. Just in way of introduction, my name is Benson Ireri. As Catherine mentioned, I work in the Office of the Special Envoy for Climate Change in Kenya, heading the Clean Cooking Delivery Unit there, which is a collaborative effort between the Office of the President through the Office of the Special Envoy for Climate Change and the Clean Cooking Alliance. I would like to request my panelists to come online. Just switch on your videos so that the participants can be able to see you. I think, as Catherine mentioned, we have a breadth of different experts drawn from development partners, financing institutions, associations of clean cooking, just to help us a bit more. Can I? If you're not speaking, sorry, if you're not speaking, could you kindly mute yourself? Adam.
Benson, you've muted yourself. You're speaking.
Benson, you're on mute.
Benson, we can't hear you. You're on mute.
We can't hear you.
Am I muted?
Good now. Thank you.
Oh, my apologies. Sorry for that. I think I was muted when you were trying to control. So our panel this afternoon brings together experts from different backgrounds, as I was mentioning, and sectors on financing for clean cooking, basically ranging from government level actors through CCDs, for example, in Sierra Leone, to clean cooking project developers, commercial banks, which are working in this space to provide capital, as well as associations and development partners in the sector. I think in the interest of time, I will not give you a chance to do a round of introductions, but instead I will request you if you could just introduce yourself as you'll be making your intervention, as well as mentioning what your organization or your institution does in this space. We'll do two sets of discussion. So one of them will be a basic reflection. Again, just kindly requesting whoever is not muted, if you're not speaking, kindly don't unmute yourself. So I will start with, sorry, I was mentioning in terms of how this session is going to look like. So we'll have two sets of interventions from each of the speaker. One of them, just a quick reflection based on the presentations that have been done by Rajiv and Akin. How does the presentation, or what's the reflection based on your country or context look like? And then number two, I will raise a question that will be looking at hearing a bit of more information from your side. My first speaker for this session is my counterpart from Sierra Leone, Aminata. Aminata, perhaps you can be able to start with sharing some bit of reflections from Sierra Leone's carbon markets sector? How is it developed, and what do you see as a government of Sierra Leone's priorities, both in terms of unlocking the space, but also more important in terms of accelerating clean cooking space? Aminata?
Thank you, Benson. I think I've already been introduced by yourself and Catherine. It's a pleasure to join colleagues from across the region to exchange experiences. The presentation from our colleague in Nigeria was very much eye-opening. For Sierra Leone, this discussion comes at a particularly important time. We are transitioning from laying the policy and the institutional foundation to building a carbon market that can support our national development priorities while also expanding access to clean cooking. Sierra Leone is still at the foundational stage in developing its carbon markets, especially with respect to implementing the Article 6 of the Paris Agreement. We just launched our National Clean Cooking Strategy last October, and this document recognizes and identifies the several priority actions, including developing a national Article 6 framework, establishing a national carbon assets registry, and creating a bilateral cooperative approach under Article 6.2. And these are the essential building blocks we're now actively pursuing. Our government's priority is very clear, and this is to establish the enabling environments that allows carbon markets to contribute meaningfully to sustainable development. One important step has been strengthening institutional coordination through the establishment of the Clean Cooking Delivery Unit, which I have the opportunity to lead, and this office sits within the Office of the President. The unit is responsible for coordinating the implementation of the clean cooking strategy. We're responsible to support the development of enabling policies, including those related to carbon finance. And just last year, government has demonstrated its commitment through fiscal reforms. Under the 2026 Finance Act, import duties on LPG equipment, clean cook stoves, solar cooking technologies have been removed. And this has helped reduce the cost for consumers while also creating a more attractive environment for private sector investments. The opportunities for clean cooking in Sierra Leone is very much significant. The National Clean Cooking Strategy estimates that achieving our access targets will require approximately $128 million in public and donor financing, while also generating more than $1.6 billion in social and economic benefits. Carbon finance is therefore recognized as one of the key financing mechanisms to bridge this gap, alongside results-based financing and also the proposed last mile innovation and enterprise growth funds. While improved biomass cook stoves and LPG have established carbon markets methodologies, we also do see enormous potential in bioethanol, which is very much untapped in Sierra Leone, but a huge potential. We also see potential in electric cooking technologies. And with targeted carbon finance and private investments, these newer technologies can expand much more rapidly and diversify our clean cooking markets. We do continue to develop our carbon markets, but we're also very keen to learn from countries that are further ahead in implementing Article 6. In particular, we want to understand how other countries in the region and internationally have successfully established national carbon registries, how they have developed transparent authorization procedures, how they have negotiated bilateral agreements, how they have operationalized systems for tracking corresponding adjustments, while also ensuring that private sector investment continues to flow efficiently. We are also interested in learning how countries have designed effective mechanisms that ensure local communities receive a fair share of carbon revenues while maintaining investor confidence and market integrity. The Clean Cooking Unit in Sierra Leone worked very closely with the Ministry of Local Governance. I joined just last year, and just moving around the country and just seeing the distribution of clean cook stoves, how the households are using them, getting feedback from the beneficiaries, making sure that mechanisms are in place for local communities to receive a fair share is top priority when it comes to the government interest. Finally, we want to see how other countries have strengthened national monitoring, reporting, and verification systems, how they have encouraged domestic financial institutions to view clean cooking and climate projects as viable investment opportunities rather than purely development interventions. So in a nutshell, I've gone over the current status for Sierra Leone, our government priorities, what are some of the opportunities for clean cooking, and what we hope to get out of these discussions, and which is knowledge sharing from countries like Kenya, for example, that is doing extremely well. And hopefully Benson and colleagues can hold our hands to make sure we get to your level within the next 2 to 5 years. Over to you, Benson.
Very good. Thank you so much, Aminata, for that reflection. I mean, the case very well laid out, and the opportunities, the need for cross-pollination, I think, of learnings, and also what Sierra Leone is doing, very well captured. I think in 1 minute, if I could ask you, Sierra Leone, I think with all humility, hasn't done very good in terms of mobilizing domestic capital for climate projects, for clean cooking, etc. And you're speaking about the need for $125 million needed. What do you think are the barriers or challenges that continue to hinder the country in terms of unlocking domestic finance?
The main barrier, Benson, I would say, is access to capital. Our interest rates that the banks do provide is over 20%. I don't know if that's the same in many countries in the region, but for local enterprises to tap into the clean cooking sector from the entrepreneurial side is almost impossible. So access to capital is a huge hindrance. We do have a local clean cooking association in Sierra Leone that I work very closely with. And even the existing players will only have 2 LPG suppliers in the country, for example, hoping to serve 8 million people. In Kenya, I do understand that you guys have around 90. I may be off a bit. So again, it just shows you that there is a lack of interest from the business side to enter into the clean cooking sector because of the access to capital.
Right. Great. Thank you so much, Aminata. I think with all the policy regulatory interventions that you've mentioned in your reflections, I think once put in place, I'm confident that those will help in terms of unlocking capital that the entrepreneurs are looking for. Thank you so much, Aminata. Now, to the next speaker, Mr. Edwin Kogong, who's a carbon portfolio head at Task Limited, which is a carbon finance and project development company with active projects in Australia, South Africa, and Zambia. Edwin, could you also share some reflections on your experience working with banks, as well as lessons from operating in multiple countries?
Thanks, Benson. Thanks for the quick introduction, and good afternoon, everyone. Yeah, sure. So as Benson already kind of introduced myself, I'll just continue on that. I'm Dr. Edwin Kogong, the carbon portfolio head at Task, and Benson just asked me to share some reflections on ourselves operating across multiple markets. So that includes the compliance markets as well as voluntary markets, and then our engagement with financial institutions. And in many ways, the two are very closely linked. So I'll just begin with a bit of background on Task, how we operate, and in which markets, and then from there go into how we've moved, well, how that's helped us move into engaging with financial institutions. So just to kick things off, Task, we are a leading project developer on the African continent. We've issued more than 12 million carbon credits to date, with the majority of those servicing into compliance markets. We currently have projects in Uganda, Zambia, Zimbabwe, Australia, as well as South Africa, with the current focus mostly concentrated in sub-Saharan Africa. We develop as well as finance carbon projects, and so far distributed over 1.2 million improved cooking devices to households across Southern Africa, delivered 50,000 water filters to households in Uganda, and have over 1 million hectares of grazing land under communal as well as commercial grazing land under regenerative agricultural management in South Africa. When we started out, and it's not necessarily just when we started out, but the majority of our projects that are implemented in Uganda, Zambia, and Zimbabwe were all originally designed for the voluntary market during a period where there was rapid growth in the voluntary market a couple of years ago. However, probably as a lot of you would know on this webinar, that boom was short-lived, and the voluntary space is very, very challenging currently to navigate, just with low demand. Everyone's waiting for Article 6 and the CORSIA market to finally take off. So like many other project developers, we've pivoted those projects to focus on moving into the Article 6 market, and we're seeking correspondingly adjusted credits for all those projects, with the hope of selling those credits into the CORSIA market. But in saying this is all still a work in progress, just because we are currently still busy engaging with the various governments while they are also developing their own carbon market framework. So it's very much a chicken and egg situation where you can't get the authorizations until the carbon market frameworks are fully operationalized, which we understand are very, very complex frameworks as well to implement. So it's made the space quite challenging. But there is some positive news in this. So the most advanced of our I would say Article 6 projects is our improved cooking program in Zimbabwe in partnership with Cicada Carbon. So we've got 2 VPAs under the gold standard, disseminating improved cook stoves to households within Zimbabwe. Both these projects are fully approved under the Zimbabwean carbon market framework and are bringing correspondingly adjusted credits to market. The only last remaining hurdle for this is currently the registry process, or the registry process under which the credits get issued, and needs to travel to ensure that the corresponding adjustment happens. Hasn't been approved by the AKO Technical Advisory Board as of yet, so those credits aren't CORSIA eligible yet. We're hoping this will sort itself out within the next couple of months, so those credits can flow into there. South Africa, on the other hand, presents a bit of a different dynamic. So here in South Africa, we operate under a carbon tax regime where large emitters are taxed on their greenhouse gas emissions, but allowed to offset a portion of those emissions through purchase and retirement of carbon credits that were generated domestically, so within South Africa. What this creates is a predictable demand for carbon credits, as well as at a legislated price. The price is legislated up until 2030, when phase 2 of the carbon tax comes to an end, meaning that as project developers, we know more or less what we can sell the credits at up until end of tax year 2030. This offers a level of certainty that's just completely absent in any other market or in the voluntary space. And this certainty really changes how projects can be developed and financed. And it's precisely this certainty that's enabled us to secure the financing arrangements that we've got with Standard Bank of South Africa. So we've got a financing structure with Standard Bank where they essentially provide financing for ongoing operations and expansion of our project in South Africa, against the sales of future carbon credits. Now, why this is largely de-risked for Standard Bank is because we've got a forward offtake agreement in place with one of the big emitters who are liable for carbon tax at a known price. Our project is already implemented and registered and eligible to go into the Carbon Offset Administration System of South Africa. So the only real risk for Standard Bank that there is lies with us, and that's delivery risk. So making sure that we issue the credits in time to meet the to meet the tax compliance deadlines for big emitters. All the other risks, volatility, market price, everything like that is negated through the carbon tax system that's put in place. So this facility has allowed us to scale operations significantly, not only within our flagship Cookstove project, but across the board, because it gives us as an organization cash in hand that we can expand our operations with, and then obviously repay our debts once the credits are issued. But just as an end to my reflection, I do think arrangements like this would be very difficult to pursue outside of set compliance schemes, just because of the volatility, uncertainty, and risk of these markets, where the one moment it's booming and the next moment Cookstove credits are trading for under $1 a ton, which really just doesn't bode well to a bankable project. And I'll end on that. Thanks, Benson. Over to you.
Thank you so much, Dr. Kogo. I mean, you started with a very scary part with the transition from voluntary to compliance market, the uncertainty in the again with the compliance with the market regulations still being developed, etc. But I think you've ended at a very positive note with the experience of South Africa and what that has actually helped in terms of unlocking finance and also de-risking in a way the market. Maybe just one final question in 1 minute, I think in the interest of time. In your opinion, what, and from your experience, what policy or regulatory intervention do you think, if it will be put in place, would help in terms of unlocking finance for project developers?
Yeah, so thanks for the question, Benson. I'll quickly just touch on two things. So one is just standardization around Article 6 and implementation of Article 6. So what we commonly see, and I'm so glad that Aminata brought this up just to learn from other countries that are already implementing frameworks successfully, is for that. There are working carbon market frameworks that allow for project development in country. And currently what we're seeing in the market is most countries are developing their frameworks in isolation, which results in completely different processes of authorization, application for project development, fee structures, and everything, which makes it very, very difficult for project developers to actually develop projects because it's pretty much different everywhere. And it just takes longer. So if there is a working structure, try and replicate that, adopt that in country. It just shortens timelines on the countryside as well and allows project development to happen. And on the second case, it's just not necessarily. So we've seen a move towards conservatism over accuracy from standard setters, which really decreases potential crediting volumes of projects. So I'm all for having accurate projects and emissions reductions being real and representative, but it shouldn't be for the sake of, conservativeness shouldn't be for the sake of accuracy, which we're seeing currently. So if you take Packham, for example, and implementing a cookstove project under their newly released methodology, so Packham is the Paris Agreement crediting mechanism, we are expecting anything between 40 to 70% less issuance as opposed to what you would get from a new gold standard or Vera methodology. And that's mostly due to deductions after the actual emissions reductions calculations, so buffer contributions, other kind of contributions to OMGE as well as adaptation fund, and it's over and above what you would normally expect. And that is also, add that with the country's requirements for revenue share to the government as well as then to local communities, it pretty much leaves about 20 to 30% of actual credits sales to finance the project activities, which is just completely unworkable. So just as well for standard setters to keep that in mind, to actually not lose accuracy for the sake of conservatism, and then ultimately to have enable projects to develop. Thank you, Benson.
Very
Sorry
well
rambling
captured.
a bit.
Yeah, thank you so much. Very well captured, Dr. Kongo. I can't summarize what you've captured very well, but I think the lessons are very clear. And I think in the interest of time, I will switch gears and go to our third speaker, Mr. Olasunkame Abioye, who's the head DFI funding, project finance and advisory, investment banking at Sterling Bank based in Lagos, Nigeria. Mr. Olasunkame, from Sterling Bank's perspective, what do you see as the role of commercial banks in financing clean cooking and broader, of course, climate investments? And I think as you speak about that, perhaps you could also share some bit of lessons in terms of blended finance. I think Dr. Kongo has also started speaking about the issues about guarantees, etc. So also how you see the role of guarantees and DFI's role, especially in crowding commercial lending.
Okay, thank you so much, Benson. This discussion is actually coming at a very right time. For Sterling Bank, we have noted the role of we've noted that for you to do any form of lending towards the clean cooking projects or even carbon financing, what is very fundamental is having different structures of financing. And when I say different structures of financing, I'm talking about blended finance, guarantees, partial credit guarantees, or even some form of subordinated debts to sort of catalyze commercial lending. And it is quite clear why this is, because it's a very nascent market in the country. I mean, compared to decades of experience that commercial banks have in financing oil and gas or manufacturing, construction, road construction, or any other form of sector. This is very nascent, and most banks do not understand where the risk is. They do not understand how they're going to get paid from it. So it is very, very important that we come up with sort of structures that are very, very, should I say, clever. Let me use that word. Are very clever and not the usual form of financing that you have around. Now, this sort of financing, what they typically would do is they will help banks to diversify into that particular into clean cooking and carbon financing, help them reduce credit losses, even enable them to do larger transactions. And speaking to how recent this particular market is in Nigeria. The federal government of Nigeria recently signed its a carbon framework, did a carbon framework just a few months ago, and they've issued a letter of authorization to a particular clean cooking project. Well, that is the only one that I'm aware of. I don't know if they've issued another one, but it is quite nascent. And the good thing about it, from the point of view of Sterling Bank, is that we work with some of the consultants that work with the federal government in coming up with the framework. And so we have some level of idea, and I must say some level of idea, because at the end of the day, we are bankers, and we would not say that we are technical guys, but we have a substantial level of idea of the sort of market that we're into, being a compliance market, and the sort of things that are needed to make things work. And to make that even to speak further to what we are even able to do, I heard one of the speakers speak earlier about introducing clean cooking into the green framework for Nigeria. And for Sterling, we have actually developed a sustainability bond framework, and clean cooking is actually part of it. Matter of fact, before the end of the year, we should be issuing a bond, a sustainability bond that enables us finance clean cooking among several other projects. So yes, from the side of Sterling, we have some level of idea on how we want to push financing into this sector. But then we cannot do it alone. We're looking for partners who can provide the sort of financing that I've spoken about, the concessionary financing, the guarantees that can help us de-risk the projects. And I think that actually now sort of links to, okay, what commercial banks would like to see, or what sort of structures have to be in place for clean cooking or carbon link projects to be truly bankable in Nigeria. And for me, I think the first thing is really education. People cannot finance what they do not understand. So banks have to be educated, and this can only happen if you have technical assistance programs where stakeholders within the sector can come to banks and make organized sessions for banks and make them understand how the clean cooking process, how clean cooking projects can be financed, and also generally just understand carbon financing. Now, for Sterling Bank, if you ask around, we're one of the foremost when it comes to renewable energy financing, and we actually have a strategy called a HEART strategy, health, education, agriculture, renewable energy, and transport, which is more of e-mobility. So we are actually at the forefront of actually financing sustainable projects. But then even in our own capacity, we know that there's still more to learn. But for majority of other banks, they do not even understand anything at all. So I think the first thing is banks have to understand what they're going to get into, and this can only be achieved with technical assistance programs. That is, I think, is number one. And the other things I've mentioned earlier, must come up with clever structures that can help us support commercial banks that can sort of crowd in and catalyze commercial lending. Some of those I've mentioned before. And another thing I've sort of thought of is for most of these projects. Now, we finance clean cooking projects in the past. But for most of the clean cooking projects that you see that most of, or let's even say sustainable projects that you find around, you find out that most of these projects or the project developers actually understand the technical aspects of what they're doing. But the commercial part of the business making a business case for the project, they do not actually understand it. So there is a part that the project developers have to take, which is to understand how to project their business, to present it as a bankable project to banks. It is only in cases like this. It is only in cases like this that you have that commercial banks can come in and say, okay, at this particular level, we think we should be able to come in and provide financing. So to sort of round it up, I think really for commercial banks, what is really important is having some sort of structure financial structure that can crowd in commercial lending. Without those structures, without understanding what they're getting into, without those structures, commercial banks will typically find it hard to come in. Thank you.
Very good. Thank you so much, Ola Sunkami. I think you've addressed even the next question that I wanted to raise with you very well in your second segment of your response. So very well captured. I think the key thing that is coming out is the need, the lack of awareness within the commercial banks, the need to provide technical assistance, but I think also more important in terms of supporting to design financing structures that can be able to crowd in commercial lending or commercial capital. So thank you so much, Olunsun Kame. In the interest of time, allow me to switch gears and go to the fourth speaker, a personal friend of mine, Mr. Eli Odhiambo, who's the national coordinator for the Clean Cooking Association of Kenya. I think, Mr. Eli, you've been hearing so much of these conversations now by this time in terms of limited capital, which I'm pretty sure, of course, your members continue to face. Despite the opportunity, of course, to transition households and institutions to clean cooking, finance remains a challenge for your companies. Could you paint a picture how does constraint continue then to hinder the companies to be able to scale up their interventions?
Thank you so much, Benson, for moderating this session. Happy to meet you and also the other panelists and participants. So let me take this opportunity to introduce myself. I'm Eli Odhiambo. I'm the National Coordinator at Clean Cooking Association of Kenya, which is a membership-based organization, non-profit making. We champion adoption of clean cooking in Kenya, both at the household level. We are champion adoption of clean cooking at institutional level and also adoption of clean cooking for commercial use. Yeah, so our members are basically at the private sector, but of course we also have development partners and people from the public sector who are also our members. I would like to pick it from where Abioy we left. And basically in Kenya, we are looking at financing from two perspectives. We are looking at financing for the end users, that is on the demand side, and also financing on the supply side. So financing for clean cooking adoption to take place, it's important that we have financing options for both sides. And one of the challenges that we face is that most companies which are dealing in clean cooking are not able to access capital, looking at working capital for their enterprises. And lack of working capital means that production is hindered, and also distribution is also hindered. So there's generally a production and distribution gap. So with this, you end up with so many companies missing tender opportunities. We have tenders which are floated by different companies, NGOs, or even government. So without capital, you find that these companies are not able to tap on these tenders and also contracts. The other aspect is in terms of benefiting from carbon projects or research-based financing. You remember, for you to be able to participate in the carbon markets, there are issues around baseline surveys. You need to have some kind of M&D audits. All these things require money. And without proper financing, you find that small and some of the medium-sized companies are not able to venture into this because they find the process to be very expensive unless they get funding from other sources. So also you find that the process for getting registered for carbon is quite lengthy. So they end up spending like 6 to 18 months just working on the process rather than engaging in business. The other aspect is on high cost of compliance and after sales. Of course, for you to be competitive in the market, the products need to be certified. In Kenya, we have the Kenya Bureau of Standards. A number of clean cooking solution standards have been developed, but it's important for these private companies to be able to comply to the different standards. These are aspects of licensing, like in Kenya, we have the Energy Petroleum Regulatory Authority, which also provides licenses. We have county level license for business operations. So all these also require financing. And without proper financing, you find that at times quality is compromised. And when quality is compromised, and also at times you find that these companies are not able to offer warranties, then this hurts the trust and reputation that we have for the clean cooking sector. The other area that I would mention is in terms of money for research and development. We need financing to be able to do innovations and scale up these innovations, commercialize these innovations. But in the absence of proper financing, you find that companies are not able to do proper research R&D. So they end up importing most of their components or some of the solutions that we need locally. So what this means is that local manufacturing remains quite low. And with the low local manufacturing, then we end up losing job opportunities for our people in the country. So that one, if you look at the demand side, you find that most of the solutions that we have are quite costly, especially if you look at electric cooking appliances. Most households or even institutions are not able to afford these solutions. And without end user financing, you find that there's low customer adoption of clean cooking solutions, which basically means that the market for these solutions will stay small because majority of the people who are supposed to be consumers of these or users of these solutions remain locked out. They are locked out of the market. Then we also have the issues around cash flow problems, especially where companies get tenders with government or institutions, but they face challenges of delayed payments. So this eventually impacts negatively on the extent to which they are able to balance their books and ensure that this continuity of operations within their organizations. Yeah, so those are some of the challenges that we face locally. But I know a number of things are being done, but maybe I don't know whether that is in your second question or I can address it at this moment.
Please go ahead. Just go ahead.
Thank you so much. Yeah, so a number of issues are being done. And I would say that as CCAK, we've also worked closely with the Office of the Climate Envoy in Kenya, the Clean Cooking Delivery Unit, in terms of developing the sector park. We now popularize the investment, the sector clean cooking sector park, whereby different investment pipelines are being developed, looking at how we can attract investment to the clean cooking sector. So at the county level, CCAK has been working with the various country governments to support development of county cooking policies, which now gives the counties the mandate to be able to allocate budgets for clean cooking adoption. We also have the county energy planning processes which take place just to provide a framework for transitioning various users of clean cooking solutions to better methods of cooking. Yeah, so a lot is happening. Also, we've been able to engage financial institutions, banks, the microfinance institutions, the SACCOs, and also in Kenya, we have government agencies which provide financial services like Youth Enterprise Development Fund, we work Women Enterprise Development Fund. So we've been able to link these financial institutions with the clean cooking businesses. We bring them together. We discuss with them the opportunities that are there in terms of financing clean cooking enterprises. Then we together discuss how the banks can make it easy for clean cooking businesses to be able to access finances. So through dialogue, we've been able to address some of the barriers that have been existing in terms of what makes it a bit difficult for these people to access financing. So this is something that is going on, and through these sensitization forums, most financial institutions in Kenya now appreciate the opportunities that exist in the clean cooking sector in terms of financing the artisans. Those are the micro, small, and medium enterprises in Kenya. So a lot of awareness is happening. But then also, if you look at that aspect of the demand, the issue of demand, the issue of behavior change communication is quite critical, because without behavior change, adoption becomes a bit difficult. So we already have the behavior change communication strategy at the national level, which we also use to do awareness campaigns just to ensure that adoption of these clean cooking solutions gain momentum and continue. Thank you so much, and back to you, Benson.
Very good. Thank you so much, Ellie. I think you've also combined the two questions that I had, but I think what is coming out clearly for you, of course, is that we cannot afford to look at only one side of the equilibrium, whether, for example, is it only just supporting the supply side, but there is also need for us to also support the demand side, to also, of course, increase affordability, which I think takes me back again to something. I think it is, what is his name? Olasun Kame was speaking about in terms of blended finance as an approach for the entire sector, in a way then, for example, beyond what local financing institutions can be able to do, what is the role of philanthropic capital, for instance, in supporting R&D and the scale up, but also in terms of project preparation, etc. So very well captured. Thank you so much, Ellie. And yes, I think my counterpart also started by speaking about the need for us to share knowledge across countries, what is working. And so perhaps the opportunity for you to connect with Sierra Leone, just to share some experiences on what the associations like CCAK can also be able to support Sierra Leone in scaling the clean cooking space. So our last speaker, last but not least, is another very good friend of mine, Lucy Nyoike. Lucy Nyoike is she's a deputy director in the CEO's office in FSD Africa, which has been doing incredible work in terms of supporting financial sector reforms. Lucy, I think having listened to all the interventions, perhaps you can be able to share with us your reflections in terms of what are some of the things that can be done to reform the sector and hence be in a position to attract more capital and investments.
Yeah, thank you. Thank you very much, Benson, and thank you to all panelists. I think the beauty with coming last is I don't have to repeat the problem. It's been squarely described. And I would like for us to reflect on what the sector really looks like. I know we've talked about capital shortages and lack of access and so on. But ideally, I would like to really directly state that we are not short of money as a financial sector across the continent. Our banks are liquid, and our institutions, say pension funds and so on, have deep pools of capital, and all this is growing. For instance, in Kenya, I think we are holding about 2 trillion shillings. And Nigeria, which is the other example that we've been using a lot here, they are holding over 20 trillion naira in terms of capital, which is available. But unfortunately, this money, since it's short tenor, it is deposit funded, most of this money is mostly invested in one asset, which is basically government bonds or treasury bills. And for bankers and asset owners, I don't think they would need to do much more because they earn double digits on these sovereign instruments with almost zero credit work. So essentially, our clean cooking assets and carbon assets are not really competing with climate assets necessarily, but they're competing with their treasury bills. And we really need just to acknowledge that. I think the second thing that is a reflection for our financial sector is also how climate entered the sector. It did come in as a risk topic through central bank regulations and disclosure requirements. I recall, Edwin talked about that, and didn't come in as a lending opportunity. So most of our climate lending or anything of that matter is still living in the compliance department and not at the origination desk. So as much as we want to access money for climate financing, basically clean cooking and carbon financing, it's hard because of the risk that is associated with it. And then we all know, everybody listening, we know that carbon arrived with a lot of reputational issues, especially around the methodologies, and most institutions are approaching this with caution. It's not that they are doubting that financing or investment is needed, it's because they need to be a bit cautious. And then secondly, we need to design clean cooking and carbon assets to be readable. We are at FSD Africa aware of how readability and legibility works because we did test it a while back when we supported BAN Manufacturing to issue the first green bond for clean cooking. It was a $10 million bond on, and it was both domestically, like basically domestic and regional investors subscribed to this 100%. And over time, I think BAN has since raised over $100 million, including from EIB and TDB. And it's not that BAN business changed, it is the packaging that changed. They were able to package the bond or the request for funding into a rated, a verified instrument that is packaged in shillings that banks and pension funds can hold on to, and essentially also providing a return that can compete with the treasury bills. The third thing I would say as a reflection is most of our institutions, especially financial sector institutions, have kind of developed what I would call quiet fatigue towards donor-shaped markets. Lots of the funding that has come around carbon assets and clean cooking has been around philanthropy. And I know, Benson, you've just mentioned that in response to Ellie. The financial sector have seen this concessional pricing undercut their commercial lending. They've seen the pilots end with funding cycles from philanthropies. They've also seen trainings come and go. I think Ola did say that the bankers need a lot of training. But I would say from our experience at FSD Africa, what really moves the money is precedent and peer evidence. So an oversubscribed bond like the one of BAN supersedes all the kind of philanthropy money that we would get. It helps money move to where it's needed most. And in my closing reflection on the financial sector in general, I would say that our sector is not really waiting to be convinced to invest. They are aware. And we have an example from, I think, Edwin, that South Africa is really supporting the carbon markets work. So convincing is already done. So what we need to really figure out is how do we package these opportunities to come in a form that survives the credit committees and beats the treasury bills returns. And I would say we have a lot to learn from Standard Bank South Africa on this particular one. How have they done it? And perhaps, Benson, we need to have another conversation with Edwin just to see how a task has been packaged in all of this. And then the other thing is, I don't think our banks really need to understand carbon markets in general. They've been around since 1997 and still we aren't there. So maybe what we need to do is change our footing and have carbon revenues look like something banks understand. In terms of, I don't know, Benson, whether I should go to the next one or just leave it to you to lead on.
I think that's perfectly okay. I'm pretty sure you want to go to the question about what are some of the reforms that you've seen in the sector.
Exactly.
Correct. Yeah, we'd be happy to hear that.
Yeah, sure. Thank you. I think for the reforms, I would just refer again back to some of the reflections I've mentioned about. So is it possible for us to extend some of the existing frameworks into clean cooking and carbon assets? So the green bonds that we have done through, say, for example, the ban one, can we extend it across the continent and spread this to kind of carbon-linked issuances? Then the other thing is, we think, I don't know whether it's Eli or Ola that talked about how carbon assets require sort of some legal identity so that we can attach them or move away from the risk. We need to give carbon a legal identity inside the financial system. Again, something that we need to learn from South Africa and task on how they are doing it. And for Kenya's case, we did come up with the carbon market regulations in 2024, and they have built up the foundation of assigning an identity to carbon markets in general. We have a registry, we have a way of authorization, whether you are heading to the what do you call them, the COSIA market or voluntary market. There is a defined benefit sharing. It adds a layer to regulators because they can attach something to it. It's not what you'd call kind of air as it has been. And then guidance on how to treat carbon receivables and so on. And I think as late as last month, July, again, Kenya has issued what I would call strategic guidelines on what carbon asset activities entail across energy, waste, and forgetting the other one. There are about 3 sectors that the government has issued clear guidelines on what activities entail. We did talk about guarantees. It is it's a good form of financial sector reform, but I would say these are not really guarantees are not sustainable in the long run. So we need to design this in a way that they disappear. So essentially, guarantees and fast loss capital are good for now as we are figuring out how to give tangibility to the carbon markets and clean cooking. But the only reason they need to be there is to be able to provide the loss data. And once that's clear, we need to clear off the guarantees and risks so that the risk, of course, will shrink as evidence accumulates across the market. So the more we get data being collected through our different clean cooking solutions and carbon assets, we should be able to get rid of the guarantees and so on. The other thing, I think Ellie has just referenced to it, most of the individual clean cooking companies are too small for corporate lending. So is it possible that we aggregate some of these companies to be able to receive sort of consolidated financing in form of securitization of the cash flows and so on, to ensure that we have tailored deals to a specific asset class that pension funds and big capital owners can tap into. And in terms of innovative approaches that I could share that we have interacted with at FSD Africa that could work across the continent is one of the first one that we were most proud of is the ban clean cooking bond. I think it was Ola that said, is it possible for some of these bond frameworks to be shared across the continent so that others can learn? It was a first 10 million in local currency, 10 million USD in local currency, and it was oversubscribed. And since then, they've been able to raise over 100 million. Can we use that template for transactions across the sector? The other one is, I think, for the last couple of years, Africa has raised roughly about 9.6 billion across 76 green bond issuances. At FSD Africa, we have supported 20 of those, and we are expected to mobilize about 1.4 billion in local currency. And this way, we are building sort of a shelf in which pension funders and insurance can buy from. And then the other work or the other innovative way that we are looking into is sort of, it's still in early stages, but sort of structured carbon finance, where we have a bit of work underway, and we're looking into pooled or tranched carbon cash flows, which can support specific instruments for specific investors. This is really in early stages, but as we work together to figure out the clean cooking financing and carbon assets financing, we'll be able to share a lot more. And then lastly, I know we've talked about gaps. And again, as part of reflection, the gap or capacity gap across the continent has shifted, I would say, with a lot of clarity in my mind. I don't think awareness is really the gap that we should be addressing. Lots of bank staffs now I see on the LinkedIn, certified financial experts, certified this, certified that. We've gone through a lot of sustainable finance training, because there has been appetite and banks have really been pushing this across their entire portfolio. And what I would say the gap really is the transaction capability. Our credit officers or relationship managers have been already bought in, but for these awareness and skill to be really tangible, they need to utilize or expense it on a real transaction. So we've created awareness, but it is the transactions, closing transactions, that is going to create capability across board. And then lastly, on the gap is we probably, in terms of awareness, just need to now focus on not the relationship managers, but the middle managers. I believe our board are fully aware of the climate and the funding. Our RMs are fully aware, but the people who sit in credit committees and are in the middle tier of banking, we really need to concentrate on those. And I stop there, Benson.
Very, very well articulated, Lucy. I really tried to signal you, but I couldn't stop you because I think the wealth of knowledge and experience that you've shared with us, I think is really rich. First, starting from the fact that money is not a problem. I think, unlike what you have been saying, that there is limited capital, there's no challenge with money. The question is, how do we unlock that money? How do we make the projects that we are structuring, whether climate projects or carbon-related projects, be more competitive compared to treasury bills? But I think also the innovations that you are sharing with us on the green bond, not just about carbon credits alone. I think very, very exciting just to hear. I will be picking up a different conversation separately with you, Lucy, especially on the aggregation model for the small companies. I think that's something that, of course, we are seeing also in Kenya on the clean cooking side of things. So how do we aggregate, and what is this model that you have seen working? But I think we'll pick that conversation separately. In the interest of time, we only have 10 minutes, and we really wanted to also leave a few minutes for question and answer. I'm pretty sure Catherine has been helping me to track all the questions coming from the participants. Catherine, do you want to come on, online and maybe share some of those?
Yes, I'm here. Hi, Benson. Hi, everyone. Thank you to all our speakers and panelists for a great discussion. To see if I can start my video. For some reason, I can't, but we'll proceed. So we have one observation with a question at the end from David. David is from Kenya, a multimedia communication expert, and he says, communication remains one of the biggest barriers to scaling high-quality carbon projects. The key communication gaps include low public awareness, where many communities do not understand what carbon credits or carbon markets are, And carbon finance is often explained using technical language that excludes local people. This creates mistrust and misinformation. There's also weak media coverage where African media often reports on climate change generally, but provides little in-depth coverage of carbon markets. Journalists may lack specialized training in climate finance. So should this be a priority as part of strategy? And this is addressed to anyone who would be happy to pick it up.
Very good. Thank you so much, Catherine. Is that the only question? Or are those the only ones before we
It's the
open
only
it
one
up?
we have so far. So yeah, if anyone else has a question, please do pop it in the chat.
All right, perfect. Thank you, Catherine. Anyone who would want to take a stab on that?
I don't mind just touching on it.
Sure.
Very briefly. I do think it is a very important point, and I do agree that communication, it should be considered strategic when looking at carbon markets, especially for Sierra Leone, we are still at the foundational stage. So a lot of what we are working on is not completely understood by all the stakeholders. One of the lessons that we are learning is that building a successful carbon market is not just about policies and the technical systems. It's also about building an understanding, building trust, building confidence amongst all stakeholders. If the communities don't understand what carbon finance is, how carbon projects work, how they will benefit, how it's going to create space for maybe some revenue for the local areas, we may have some misinformation. And we saw that with one of the companies in Sierra Leone distributing clean cook stoves in the rural areas. So I do think communities need to understand what is carbon finance, and that is through communications. There's also a very important role for the media. Journalists, in collaboration with the government, can be key partners in translating complex climate finance issues into languages that communities, businesses, policymakers can understand. And building the capacity of the media to report accurately on carbon markets can help to improve the transparency that we desire, strengthen the public confidence, highlight the real development benefits of projects such as clean cooking. For Sierra Leone, as we develop the national carbon markets architecture, stakeholder engagement and public awareness is going to be critical alongside the technical work of establishing a national registry, the governance system we're trying to establish and ensure it's sustainable, and also the Article 6 procedures. A carbon market can only be successful if the people it is intended to benefit understand it, trust it, and can see the tangible value in participating. So I do see that communication and public awareness can be an integral part of a successful carbon strategy, not an add-on, but also an essential pillar for long-term success. So I thought that was a very good question.
Thanks so much, Aminata. We have a few more here, Benson. So I have a question on green bonds. And this one is from Abhishek. He says, do we have elaborate eligibility criteria and audit criteria for selection and disbursement of capital? Are these criteria aligned with Article 6 of the Paris Agreement?
Maybe Lucy?
Yes. Yeah, yes, thank you. Yes, the criteria exist across board. As I said earlier, as a continent, we've done about 76 green bond issuances, and these frameworks are publicly available. Happy to share that. And out of that, we've been able to raise about 9.6 billion US dollars. And because some of these frameworks are replicable, any transaction that could be perhaps take longer to figure out the eligibility criteria and all of that can use either of the 76 to see where it fits best. So some of these things don't have to be redone. The process for green bond is usually the same world over. It's the framework that changes depending on what you're capital raising for and so on. So yes, aligned to Article 6 or aligned to whichever other SDG goal that the issuer is trying to align to.
Thanks, Lucy. Benson, do you have time for one or two more questions?
Sure, go ahead.
Okay, the next one is from Joseph Fernandez. Would including PayGo solutions into the clean cooking products facilitate access to commercial financing? And do commercial lenders have tools to assess the credit risk of non-traditional borrowers, i.e. those without a bank account, for example? I think that's for Olasunkanmi.
Thank you. So I think really, aside clean cooking, so we have, and I've seen it in Nigeria that institutions have actually financed maybe renewable energy products that have the pay-as-you-go model. So yes, including that in clean cooking is something that can work. At the end of the day, what it means is that it is consumer financing, really. So consumer financing comes with its risks. So it's the structuring around it that really would make it bankable. Pay as you go on its own is not an issue. It's as with any form of credit, what you need to do is to find some sort of structure around it to make it work. And we have actually done that on some other type of projects, particularly renewable energy products that we sort of finance, solar home systems basically that we sort of finance. So yes, it's possible, and commercial banks can do that. I missed the second part of the question.
Do commercial lenders have the tools to assess the credit risk of non-traditional borrowers, so those without a bank account, for example?
Yeah, so in that sort of situation, what you can do is you can go through maybe cooperatives. So you can go to some sort of cooperatives, and we've actually done something like that in the past. So you sort of have to group all the lenders into buckets. So maybe you have some cooperatives, or you have some sort of union that you go through. You know the leaders, you know their constitutional documents and all that. So basically, what you're going to be doing is you're probably lending to that cooperative, and the cooperative members, knowing themselves, can sort of having their own register, can actually distribute. So it's all a function of having it's all a function of understanding what needs to be done, understanding where the risks are and how you mitigate the risk. So there's no project of its own, including clean cooking, that cannot be mitigated. It's for people to understand where the credit risk lies, or where the technical risk lies, or where the performance risk lies, and try to find structures around it to make it work. So yes, commercial banks may not need to have your accounts to disburse funding or avail funding to such projects.
Thank you. I think I'm going to hand over to Benson. We have a minute left now, so I can see your questions. We'll try and get back to you via email. Benson, over to you.
Great. Thank you so much, Catherine, for managing that segment for us. I think as we come to the end of this session, even for me, has been quite an eye-opener. So I think first and foremost is to thank the organizers for this session. I think the way we are used to summarizing this kind of sessions is you start from the beginning to the end. But I think the major takeaway for me is that money is not a problem, and especially from our local financing institutions. The question is, how do we unlock that capital for clean cooking and climate investment projects? I think one thing that is coming out is increasingly, of course, the perception about carbon credits, for example, carbon-linked deals. And how do we then turn that into something that is quite competitive? I think I'm still trying to think on the treasury bond example that Lucy was giving us, which I think is something that definitely we need to see how do we then make both carbon linked projects, climate investment become very, very competitive. The beauty is that there's so much that is already going on, whether, for instance, the example that Dr. Coco gave us with the immense work that they're doing across the continent in project design, whether it's the example from Nigeria, I think quite impressive innovations happening. The bigger question is going back to what Aminata started with. How do we ensure that we can also be able to share lessons and learning? So that, again, there's no need to reinvent the wheel. If there's something that has been progressive, that has proven to be quite something that other countries can be able to learn from, how do we then make sure that we can be able to share those lessons? I think speaking on behalf of CCA is that there's commitment to continue supporting countries with a suite of the 15 regulatory policy and regulatory interventions that Atin shared at the beginning of the presentation, just to see which, for example, then is the most ideal to help unlock a particular local market or financial market. And so I think let's see how we can continue working together. In case there is any question any one of us had and you've not been in a position to raise, please feel free to get in touch directly with Catherine, and we'll be in a position to see how we can also be able to connect you with any of the speakers. Otherwise, mine is to thank all the panelists, all the presenters, and of course, all the participants who've taken their time to just come in and listen and learn. And I hope that this conversation was helpful to you. And also to getting to understand how we can be able to support the sector to unlock the finance and investment required for the sector. Thank you very much, and wishing you a wonderful day and a good evening for those who are coming to the end of their day. Asanteni.
Thanks everyone.
Bye.
Thank you.
Thank you.
Thank you.
Thank you.
Bye, everyone.
Bye-bye.